Now, once we've calculated the contribution margin, we can move on to calculating the break-even points. And there's two types of break-even points within a break-even analysis. And this is the simplest form here. The two types are unit sales to break even and dollar sales to break even. And respectively, what they refer to is the number of units that it takes to cover all of my costs. In other words, the number of units I must sell to have enough sales revenue to pay all my fixed expenses. And respectively, the number of dollars, in terms of dollars, how many sales I must generate to earn enough revenue to cover all my expenses. And so the formulas you can see are pretty similar. The first one here is for unit sales to break even is fixed expenses divided by the contribution margin per unit. So again, to remember, think units to units. And for our simple problem here, the fixed expenses for this bike shop is $80,000. The contribution margin per unit was $200 per bike. So I need to sell 400 bikes in order to make enough revenue to not only cover my variable costs, but also my fixed costs. Essentially, this is the number of bikes I need to sell to keep the lights on, pay any employees I have, and buy enough material to keep making bikes, 400. Now I can think about this, and this is exactly the same information, it's just presented in a different unit when we talk about dollar sales to break even. So dollar sales to break even is fixed expenses divided by the contribution margin ratio. And so that's $80,000 divided by 40%, where 40% is the ratio of what's left over after I account for variable expenses. Right? So we flip back to this, and we can see $200 is my contribution margin per unit, and 40% is my contribution margin ratio. And ultimately that means that I need to raise $200,000 worth of revenue from selling my bikes in order to cover all my expenses, keep the lights on, do everything back. So that is my first hurdle to clear, right? If my predictions about the future are not close or are too close to a level of sales, or what's a better way to say it? My prediction about the future is that I'm going to sell 500 bikes. What I'm interested in when I'm looking at break-even analysis is how close are each of these break-even points to my best prediction about the future, right? So I think I'll sell 500, but if I only sell 400, I can still pay all the bills, pay my employees, keep the lights on, right? So that gives us some level of comfort, because 500, that's 100 bikes more than what I need to keep all the lights on is what I'm expecting. If I was only expecting, say, 410 sales per year, then I'd be really close to this margin where if I'm wrong, I could be wrong such that I can't pay all the bills that I have to pay. And that's what I'm concerned with when I'm talking about break-even analysis. I'm trying to look at these different levels of sales and how that might compare to what my expectation is about sales, and where that might put me if I'm wrong about my expectations. And we can represent this graphically through what's called a cost volume profit graph. And it can be a very helpful thing to present these kind of analyses graphically, just because graphing something makes it so much easier to interpret. So the way we start with our cost volume profit graph is we start with a horizontal line that's equal to our fixed expenses, right? So here on the x-axis we have units, and on the y-axis we have dollars, revenue is in dollars. And what I'm graphing here, this solid red line, is the fixed expenses. And notice that those are flat because they don't change depending on the number of units I sell. So it's just going to be $80,000 no matter what. And the next thing I drew is I draw my cost function, where my cost function has an x-intercept or a y-intercept of equal to $80,000, which is my fixed expenses, but then has a slope that is 300, my variable cost, times the number of units I sell, right? So that's this blue line. Notice that it is slowly increasing by units And of course, that's what we expect. This is my variable cost added on to my fixed cost, and my variable cost should increase by the number of units. In other words, I should have significantly more variable costs when I sell significantly more units. Now, what I'm interested in here is this green line, and particularly in the intersection of the green and the blue lines. So the green line is my sales function, and my sales function is purely an increasing function with a slope related to how many bikes I sell and the price per bike. So $500 is my price per bike, and I get $500 every time I sell an additional bike. So $50,000 for 100 bikes, and so on and so forth, right? Now notice that the green line starts out significantly beneath my fixed expenses, because my fixed expenses are $80,000 no matter whether I've sold one bike or 1,000. So before I sell any bikes, I'm already on the hook for $80,000. So I need to sell at least enough bikes to cover my fixed expenses. But of course, every bike I sell, I can't collect that entire $500 and put it towards fixed expenses. I can only collect what's left over after I pay off all the parts, after I buy the parts to make the bike. Those are my variable costs. What's left over is my contribution margin. And so ultimately, where the intersection between my sales line and my total cost line is going to be at the contribution margin or at the break-even point limit. And you can see here that we cross the green and blue lines cross at 400 units or $200,000. That is the point at which I have generated enough contribution margin to cover both my fixed and variable expenses. And at that point, I start to make a profit. So notice that anything above 400 units is a profit area for me. My sales line is above my cost line, and I start generating accounting profit. Anything below that, and I'm making a loss. So that's why the break-even point is so important. It tells me this hard and fast rule where I'm going to make either a profit or a loss. And I want to make sure that my expectation about the future is pretty far from that point. Otherwise, I should be concerned that things might not turn out the way I expect them to. Now, we can make our problem a little more realistic by including the purchase and investment of fixed assets for our bike shop, right? So maybe we need some machinery to put our bikes together. Maybe we need some machinery for calibration. Maybe we need computers and things like that to do our accounting stuff. Whatever the case might be, I might need a truck or a van to deliver the bikes to bike shops, things like that, right? So I'm gonna make it more realistic by adding in some lump sum initial cost. And when I do that, of course, I'm gonna have to add in accounting for depreciation as an additional cost. And again, this is just an accounting cost, but it is an additional cost on the income statement, right? So I want to think about the next step of break-even analysis is what we call accounting break-even. And the accounting break-even is the level of sales at which accounting profit is zero. Right? And accounting profit is net income. Right? And so I want to say, what's the level of sales at which I cover all my costs, including my depreciation, but I have zero EBIT, so I pay no taxes, and because of that, I have zero net income. Right? So anything above that, I start to make profit. Anything below this accounting break-even point, I am still earning an accounting loss, even though I am covering my costs. Right? Well, and so to make it more tractable, let's jump back to our original example, the one that we documented in the Excel file, and. So we have an investment. We're going to need to make a $5.4 million investment in fixed assets. We got variable cost of 81% of sales, fixed cost of $2 million, and depreciation. Now we're doing just straight line to zero depreciation here. 5.4 million divided by the 12 years of useful life of the project, $450 in depreciation. So we want to know the accounting break-even level of sales. And the accounting break-even level is very similar to the formulas that we just looked at, except because we now also have to account for depreciation of the asset, we change the formula slightly. So dollar sales to break even is fixed cost plus depreciation divided by the contribution margin ratio. So it's not just fixed cost divided by the ratio, now it's fixed cost plus depreciation divided by the contribution margin ratio. And that'll tell us the dollar level of sales that we need for break even. So if we look at our numbers here, the break even point is 1 minus the variable cost percentage. That's what's left over to cover our fixed costs. And our variable cost percentage is 81% of sales, 81.25% of sales. So the contribution margin is 1 minus that, or 18.75% of sales. So if I divide 2 million in fixed costs plus 450,000 in depreciation by 0.1875, I get a break-even level of sales of 13,067,000. So at this level, we generate enough income to cover our fixed cost, our variable cost, and our depreciation expense. And that means we recover all of our costs, but not a dollar more. I don't make any profit. I don't generate any additional compensation for taking risk, right? So I don't have any consideration of time value of money. But at the very least, I don't lose anything. I just don't make anything. Not the best place to be, but it is a very useful point to know, and it's a very useful thing to understand about our project.